compounding or simple averaging. Forget about the question of this one is a compound interest, this one is simple interest. No. And identify the real reasons or the hidden factor that makes an opportunity better than others. Because this is the real difference between a compounding platform and a non-compounding one. It is a question of convenience of the interest element. If an investment combines the interest account and the principal or investment account into one, meaning that the interest when paid is paid to the principal investment account, that becomes a compounding investment. If rolled over, where the interest is paid to a different account, that the principal account and the interest income account are separated, then that is when we talk of simple interest. So it's a question of convenience. And once we have that information, then we are able to identify other more important factors. Because when I know the only difference between an opportunity that is being regarded as compounding and another one simple is the convenience of joining the income account and the investment account, then it means that as an investor, I'm the one in a simple investment or a non-compounding one, I'm the one who is supposed to reroute the interest paid back to the investment account for further investing or for a rollover investment. With that, I'll leave the question of compounding aside. Then I look at another factor. And the next factor that is very critical and ignored by many people when making decision of choice of where to put the investment is the frequency. The frequency of computation or the frequency of payout. And take note, this is the factor that makes a money market fund better than many of these other platforms. Because a money market fund calculates your interest on a daily basis, meaning that it can give us a frequency of over 360 days in 1 year, as opposed to a fixed deposit account that may give us one frequency of computation in a period. Because if I invest for a whole year, it will be computed for once. If I invest for 3 months, that is a frequency of 1. But in a fixed deposit account, I can take advantage of compounding if I choose to reinvest the principal and the interest paid out over quarterly period, meaning that I will have a frequency of 4 computations in a year, where that is what is bringing out the compounding element. A money market brings out the compounding element, convenience, because the interest calculated is loaded on the investment balance carried forward from the previous day to become the balance brought down for investment in the following day. So this multiplicity of computation and payout of interest is what will determine or what catalyzes the huge growth in that investment. Very important. The frequency or the number of times interest shall be calculated and reinvested. That is one critical factor that you must look at. And that is what is real compounding. So compounding is about frequency of computations and reinvestment. Money market fund gives us that and the convenience that we do not need to actively get involved in the reinvestment of the payout. Take an example of a treasury bill. A treasury bill can give us an opportunity for the same. And remember, treasury bills and bonds, more or less, they'll give rates that are not too far from what the money market funds are giving us. But the frequency of compounding will differ, and the convenience. So if I invest 100,000 in a treasury bill, then the discounted amount of income, the discount, because treasury bills are discounted. This amount that has already been discounted at the point of investment, I use it and put it in a money market fund, because potentially that one will not be enough to buy another bill. I've already compounded. So it's possible to generate more money out of a treasury bill by reinvesting the discounted amount than even a money market fund. But not, it is the element of convenience that lacks in the treasury bill. Another third factor that is very important in investment. You will note that in investments, the outcome not necessarily depends on the compound method, the convenience, and the rate, but it greatly depends on the amount that you put in that investment. Your initial investment and the top-ups and how regular those top-ups are will determine greatly the outcome at the end of the investment period. So those are three key elements, three key factors that you need to look at, besides other many factors like flexibility, accessibility, security, and other factors that you'll have to look at when you're investing. I've identified the three because they potentially determine the amount overall, the quality of the outcome of that investment. Remember, it is the number of times of the frequency of compounding or interest calculation and payout, and the amounts that you put in the investment, and not the interest rate and the method used in that calculation. Once you have identified that, then we can identify a chain of investment where one rolls into the other as another key element to look at, especially when we are talking of rolling from low investment outlays towards huge investment outlets. For example, I want to take up an investment in the treasury bills, treasury bonds, which require substantial amount, 100,000 for the bills and 50,000 for the bonds. I may not be able to raise that amount at once, but I can use the money market fund and build-ups or monthly top-ups, which will yield over time to the required amount to invest or venture into the bond market. Those are salient factors to look at. Then at last, there is budgeting, which is also very crucial.